Did you know that you don't pay state or local income tax on any Treasury securities, including Treasury bills? Welcome to another edition of the ACAP Recap, where we go beyond the blog and answer some of your most important questions. Today, we're going to talk about the taxation of T-bills, also known as Treasury bills. For the longest time, interest rates were held at the absolute lowest level, and this was great for people who were either homeowners that were trying to refinance or people that were looking to buy their first or maybe second home because interest rates were so low. But it was a terrible thing for savers because savers earned absolutely nothing on their savings account, and because the interest rates were so low, it forced savers to take more risk by buying other riskier assets. In March 2022, the Fed started raising interest rates to combat inflation, and as a result, T-bills, which were pretty much a forgotten investment, all of a sudden started becoming popular again because the rates started becoming more attractive. And now, as a result, savers can now earn a decent money on their savings account by buying Treasury bills or T-bills. So let's first start off by defining what is a Treasury bill, also known as a T-bill. T-bills are short-term government debt that are issued by the U.S. government by the full faith and credit of the U.S. government and are deemed very safe and have no default risk or very little default risk. Now, if something were to happen with the U.S. Treasuries, then it would be a world calamity, which is the reason why anytime there is a world calamity, many people all over the world flock to U.S. Treasuries as a safe haven to park their money because they know that U.S. Treasuries have a very, very deep market, meaning you can park hundreds of millions of dollars into a U.S. Treasury in the morning and then pull that money out in the afternoon or the following day without having any issues with prices. So T-bills come, because they're short-term, they come in 6 different increments. You can either buy them in 6 weeks or 4 weeks, 8 weeks, 13 weeks, 17 weeks, 26 weeks, or 52-week increments. There are all types of U.S. Treasuries. There are T-bills, bonds, notes. These are all considered U.S. Treasuries. What differentiates them is their maturities. So a T-bill is up to 1 year maturity, so it's a short-term instrument. A note is a midterm instrument or short to midterm instrument, so up to 10 years. And a bond is anything long-term beyond 10 years. Notes and bonds, U.S. Treasury notes and bonds, pay interest every 6 months, but T-bills pay interest upon maturity, which is an important factor when we're calculating the interest rate and the taxation. As I mentioned earlier, T-bills are exempt from state and local income taxes, which makes them very appealing for people who live in high income states or high income tax states such as California and New York. So if you're a high income earner and you live in California and New York, a T-bill is very appealing because you're not going to pay state income tax on that interest that you earn from the T-bill. Now, keep in mind that you still have to pay federal income tax regardless of which state you live in on the income that you earn from those T-bills. So the interest income you earn from the T-bills, you still report that on your federal tax return and pay tax on it. T-bills are sold at a discount, meaning that you buy the T-bill at below what the face value is. So for example, if the face value of a T-bill is $1,000, you'll probably pay like $980. And then when it matures, you'll get the $1,000. And that difference of $20 is the interest income that you earn. At the end of the year, you're going to get a 1099 INT, which is a form from the IRS that says how much interest you earned on your Treasury bill. Now, if you want to know more about 1099s, you can watch my other video I did where I talk about all sorts of 1099s and how to report them. So once you receive your 1099 INT, you're going to report that on Schedule B of your 1040 with all your other interest income. So the interest income you receive from your banks or any other interest that you receive, you're going to report that along with the interest from your T-bills, and you're going to pay federal income tax on it. If you're in a state, remember, you do not pay state income tax on the T-bill. In addition, you can withhold up to 50% of taxes from the interest that you earn on your Treasury bills. For example, if you wanted to withhold taxes from your T-bill interest so that way you're not going to have a large tax bill at the end of the year, you can have your broker or your U.S. Treasury withhold up to 50% of the interest that you earn as federal income taxes and remit that to the IRS. That way, when you file your taxes, you're not going to have a huge tax bill because you've already withheld some of that income as taxes. The T-bill market is massive. It's over $27 trillion, and it's considered a very deep and liquid market. What that means is, as I said earlier, you can park hundreds of millions of dollars into a Treasury bill or a T-bill and know that it's safe and accessible anytime you want. In fact, you can sell a T-bill anytime you want, and all you're going to lose is the interest that you would have earned had you held it to maturity. So you're going to continue to earn interest from when you bought it up until the point when you sell it. Also, T-bills are very popular right now because interest rates are so high. When interest rates go down, when the Fed lowers interest rates, then the T-bill rates will also come down. But then again, remember, the bank interest rates will also come down as well. And at that point, you have to determine, does it make sense to keep my money at a bank and earn a market interest rate? Or do I want to go through the hassle of buying a T-bill and earning a similar rate, even though that might be exempt from state and local income taxes? Okay, when you're thinking about buying a Treasury bill versus a certificate of deposit or a bank deposit, you want to take into consideration what's known as the tax equivalent yield. So for example, let's take these two investment options. We have the choice between a CD or a Treasury bill. And let's assume we're going to invest $1,000 into either a CD or a T-bill. And the interest rate is going to be the same, 5%. If we put the money into a bank CD, we're going to earn $50 of interest at the end of the year. And assuming we're in a federal rate of 40% and live in the state of California at a maximum rate of 10%, you're going to pay $25 in total taxes. $20 will be towards federal because $20 is 40% of the $50 that's earned. And then $5 would be to the state, which is 10% of the $50 that's earned. So the net interest that's earned is $25 because you received $50 of interest earned and you paid $25 of taxes, $20 to federal, $5 to California, and then your net interest earned is $25. So as you can see, the effective yield, which is the yield after you've paid taxes on that $1,000, is 2.5%. And the way we calculated that is the net interest that you earn after you pay taxes divided by how much your initial deposit was gives you that effective yield of 2.5%. Now, comparatively speaking, if we had put that $1,000 into a T-bill, you would still earn 5%. The interest that you'd earn is $50. You'd still pay the same federal tax because remember, T-bills are not exempt from federal tax. You still have to pay federal tax on that, but they are exempt from California tax or state tax. So you'd avoid that tax of $5 to California. So your total tax that you paid is $20. The net interest earned is $30, which would mean that your total interest is $50. You paid $20 of federal tax, and then what you have left over is $30. Therefore, your effective yield, the yield after you pay tax, is 3%. So you can see when we're comparing these two investment instruments, the CD and the T-bill, and the interest rates are the same and you live in a high tax state, the T-bill offers a higher effective yield because you're paying tax, state income tax, on some of that interest income. Now, when you're trying to evaluate between a CD and a T-bill and you live in a high tax state like California, what you want to do is you want to calculate what your effective yield is going to be, your tax equivalent yield, to be able to do an apples to apples comparison. So here's what we're doing in the next column here is we're looking at how much additional interest you would have to earn to get to the equivalent of a T-bill rate with the same other factors. You're putting in $1,000. Your interest that you're earning, instead of the 5%, you'd have to earn 6% interest on that CD now to be able to earn the same effective yield that you would had you put that $1,000 into a 5% T-bill. So the bottom line is when you're trying to compare a T-bill with another similar investment instrument, you want to make sure that you calculate the tax equivalent yield so that way you know that you're going to at the end get the same amount of money after taxes that you would have if you put it your money into a different instrument. So now that you know what a Treasury bill is or a T-bill is and how T-bills are taxed, you obviously want to know how you can purchase a T-bill. Well, you can do it in a number of different ways. You can either buy it directly through Treasury Direct, and I'll put the link below, or you can use your existing brokers such as Charles Schwab, Fidelity, E-Trade. Either one of those platforms, you're able to buy a T-bill. Keep in mind that T-bills are only bought and sold electronically. So even if you buy it through Treasury Direct directly, you're not going to be able to get a paper certificate like you did many, many years ago. Everything is done electronically. So if you want to buy a T-bill, your best bet is to either go through Treasury Direct or to buy through an existing broker like Schwab, Fidelity, E-Trade. Either one of those places, you're able to buy a T-bill. Here are some common questions I received regarding Treasury bills. The first one is, do I have to hold the T-bill until it matures? And the answer is no. You can sell your T-bill anytime you want. The only thing is you're just going to earn interest from the time you hold the T-bill until the time you sell it. So if you bought a 6-month T-bill and you sell it in 3 months, you're going to earn interest from the first 3 months, and then the second 3 months, obviously you're not going to earn interest because you don't own that T-bill anymore. Are T-bills FDIC insured? T-bills are not FDIC insured. However, they are backed by the full faith and credit of the U.S. government. So if something were to happen to the U.S. government, then the FDIC insurance itself would also be insolvent. Another common question I get is, why should I buy a T-bill? Well, T-bills are a great place to park your money in the event you need to use it for something. So it's a great place to park your emergency cash reserve or a place to put your money that you earmarked to buy something in the near future. And they're extremely liquid. So you can put millions and millions of dollars into a T-bill and have that money available whenever you need it at a moment's notice. The next question is, what happens when the T-bill matures? And once your T-bill matures, the money is not automatically invested. The money becomes cash, so you get the face value of your T-bill. Because remember, when you buy a T-bill, you buy it at a discount, and then when it matures, you get the face value. And essentially, that face value goes into your bank account or your investment account, and you have to actively decide whether or not you want to reinvest that T-bill into a new T-bill at whatever maturity you want, or you can withdraw that money or do whatever you want with it. So are T-bills better than CDs or certificates of deposit? And the answer is it depends. It depends on what the interest rate is on the T-bill and what the interest rate is on the CD. So earlier in the video, we talked about the tax equivalent yield. When you're trying to compare a CD with a T-bill, you want to make sure that the CD's interest rate is high enough to capture the federal tax that's owed and the state tax that's owed, because an equivalent T-bill will not be subject to state income tax. So you want to make sure that you're comparing apples to apples when you're looking at the different interest rates between the CD or savings account, whichever one you want to compare it to a T-bill. Another question I receive is, do T-bills automatically renew or get reinvested? And the answer is no. T-bills do not automatically get reinvested. You have to actively reinvest the proceeds once the T-bill matures. Common question I receive is, do you have to pay state income tax on the interest earned on a T-bill? The answer is no. T-bills are exempt from state and local income taxes. Do you have to pay federal income tax on interest received on a T-bill? Yes. Income that you earn on a T-bill, the interest income, is subject to federal income tax, and you have to report it on your Schedule B of your 1040 and pay tax on that income. Do you have to pay capital gains tax on T-bills? Well, yes, technically, if you buy a T-bill and you sell it for more than what you paid for it, you will have to pay capital gains tax on it. But it's very, very unlikely because T-bills are very short term and you buy them at a discount. The likelihood that you're going to buy a T-bill and sell it for more than you paid for it, not including interest income, is very unlikely. Thank you for joining us for another edition of the ACAP Recap, where today we cover the taxation of Treasury bills, also known as T-bills. If there's a topic you want us to cover, put it in the comment section below, and I'll make sure to cover it in a future video. If you like these videos, be sure to also subscribe, like, and share our channel. That way we can continue to produce content like this.